is Rohan from Mescht. I'm an actuary working at Momentum for the past 5 years. I have some experience working in the structured investments and annuities product house. About a year ago, I've transitioned into the distribution team, so doing a lot of engagements with brokers and clients on all of our product offerings. Really enjoying the new role and the new challenge, and also bring knowledge from product into the distribution space, which can hopefully help the business going forward.
Thank you so much. Speaking about joining the SIA team, recently we spoke to Hugh Hacking, and he was sort of speaking about the current state of the world with volatility in the market and all of that's happening and the impact on investments. And one of the things he mentioned was smooth bonus, which is why we're here today. So we just want to deep dive a little bit into smooth bonus. What is it?
So smooth bonus, it kind of all sits in the name, the smooth part. It's an investment portfolio that is aimed towards giving investors a bit of a smoother ride. We know that investing for retirement or investing in general can be a bumpy journey. So a smooth bonus portfolio is basically an investment portfolio where your returns do not solely depend on the market, but is made more stable over time by holding back some of the returns in the good years to support during years of weaker returns. So this helps your investment grow more steadily instead of going up and down with market movements. So smooth bonus portfolios also offer various levels of protection, meaning they will shield part of your capital from losses during market downturns. We'll get into that a bit later. I don't want to get too technical, but basically because of these smoothing and protection mechanisms that these portfolios offer, they generally have a lower volatility than traditional market-linked portfolios that invest in the same asset classes. So really aimed at giving you a smoother investment journey over the period.
Are you able to tell us how it works behind the scenes? Like, how are returns sort of smooth, and what happens in strong markets during versus weaker markets? I'm assuming right now would constitute weak markets. Is that correct?
That's a good question. I mean, let's start with the first question you asked around the smoothing of returns. So that's a very good question. I mean, I told you now that the aim of this is smoothing out returns and giving you a less bumpy journey towards retirement or towards your savings goal. But so how are these returns actually smooth, and how do we decide what to distribute? So we have a smoothing formula that gets used in the back end that gets set up by the actuaries. I'm not going to go into all the technical detail of exactly how it works, but largely speaking, there's a smoothing period, which basically means that there's a period that you choose, for example, 12 months or 18 months, over which you consider the returns over that period, and then you kind of smooth it out. However, returns earned is not the only thing we take into account when declaring these bonuses. So when I talk about bonuses, the bonus in a smooth bonus portfolio basically just refers to the return that the investor is getting on this portfolio. It's not a bonus like a 13th check. It sometimes does get confusing. It is the return that the investor will actually earn. So the returns earned in the market is the main driver of the bonus declaration. However, the smoothing formula also takes some other things into account, like economic outlook. You mentioned, weak versus strong markets. So maybe jumping into that, a smooth bonus portfolio is supposed to, in strong market conditions or times during when markets run, it's geared towards still giving investors the upside exposure. So you will still participate in market runs, albeit at a bit of a slower pace maybe than a market-linked portfolio. And this is not necessarily a negative thing, because in a market-linked portfolio, markets can go up by 10% one month and down by 5% the next month. Whereas in a smooth bonus portfolio, you'll still uptake, but you might have a bit of a longer journey. So actually participate in the upside returns over a longer term. In terms of, I think you used the word weaker market conditions or times of market downturns, even negative returns. This is really where we expect the protection mechanisms within this portfolios to kick in. And when I say protection mechanisms, depending on the type of smooth bonus portfolio that you're in, there's varying levels of guarantees. So we offer guarantees on the capital that you invest, which means initial investments, regular payments that you make towards the portfolio, and we also offer some level of guarantees on what we call benefit payments. So that's payments made during benefit payment events, which is events like death, retirement, retrenchments, etc. So there's certain guarantees that protects the policyholder if they were to, for example, retire during a time of market downturn. So it's really a kind of, we try to do a best of both worlds, whereas if markets run, you still participate in the upside, but if there's a market downturn, we have the smoothing and protection mechanisms to really support the policyholder.
Oh, that sounds amazing. So I have a retirement fund. Therefore, I can assume that, I can see myself as an investor. Am I the audience for this? Can I take one out or not? Who can actually take out a smooth bonus?
So in short, I mean, anyone can take out a smooth bonus product or invest in a smooth bonus portfolio. I guess the better question to ask is, who is it really suitable for? Who would it benefit the most? And I think in broad terms, it benefits any investor who is looking for a less volatile and or portfolio that provides a bit of protection. So let me maybe elaborate a bit on this. If you are more on the risk averse side of the scale, Investments 101 tells us that, to compile a portfolio with low volatility, you need to invest in lower risk assets like cash and bonds, etc. However, we all know you mentioned the journey to retirement, and I will never ask a woman her age, but judging by the picture in front of me, I would say that you are still on the young side of things. So you have a long journey to retirement. So if you're a risk averse investor, but you still have quite a bit to go, towards retirement. We know that you're investing for the long term, and anyone with some investment knowledge will tell you that yes, we can compile a low volatility portfolio, but the real growth exposure lies with what we call growth assets. So that's your property and your equity, etc. So the $1 million question really is, can we marry the two? Can we construct a low volatility portfolio for our risk averse investor who doesn't like the ups and downs of the market, maybe can't afford the volatility or simply can't stomach it, but still give them upside exposure to these growth assets? And this is exactly what a smooth bonus portfolio tries to do, speaking to my earlier point, trying to give you the upside of the market returns while protecting on the downside. So yeah, I hope that answers the question, but really is for young and old, anyone who falls more on the risk averse side of the scale, who needs some sort of protection, who wants a bit of smoothing and a more comfortable and less bumpy journey towards retirement.
And is it unique to Momentum?
So no, a smooth bonus product or smooth bonus products are very common in the market. Most of the large insurers offer these sorts of products, and I think that speaks to the need for these products within the entire South African market.
And I think it's become quite crucial because I think at some point 6-7 years ago we thought there's a very specific norm when it comes to markets, but now we know volatility is the norm. We keep waiting for it to pass, but there's always one thing after the next. So it's become quite crucial to have one of those, to just keep your investment smoothed out, throughout your retirement journey.
So I think in summary, what I would say is different strokes for different folks, each to their own. I'm not saying, everyone must go and invest in a smooth bonus portfolio. There is a specific target market for this portfolio, and I think we covered it earlier. If you are someone who does not like volatility, who wants a comfortable journey, who gets distressed when you see markets going down by 10% because Trump invaded Iran and your retirement savings took a dip, that is someone that we would like to see invested, or at least considering a smooth bonus product. If you're someone that's currently investing in a lower risk portfolio and you think that that's the only way to move money into cash or bonds or lower risk assets to bring down, riskiness and volatility, consider a smooth bonus portfolio where you can have increased growth exposure, especially within the momentum portfolios. I think this is one of the distinguishing features of our smooth bonus portfolios. You can keep that growth exposure, but we protect on the downside. We have the smoothing mechanisms to really give you the best of both worlds.
Amazing. Thank you so much. This was very, very helpful. I think I know a little bit more now than I did when I came in. So appreciate it. I hope everyone else does as well. Thank you, Rohan.
Thank you very much. I appreciate it.